Hey everyone, welcome back to the REI Marketing Secrets podcast. Today on the show, we have Ross McArthur. And Ross, for our audience out there that's just learning about yourself for the very first time, do you mind just going into a little bit about your background and how you got started investing in real estate?
Yeah, absolutely. So again, Ross McArthur, born and raised in Michigan, as I say, because it makes a little more sense later. But for the last 10 years or so, I've been in Central Florida. But how we got, I guess, started investing could be a 30-minute story or it could be a 5-minute story. So we'll stick with the short version. But I grew up in a middle class family. I really didn't have any investors around me. But my mom was, the financial brain in my mom and dad's relationship. So took care of the finances and things like that as far as paying bills and managing budgets. And so she always taught us really early on, like basic 101 finances, which I could go on for an hour of how important that really is teaching kids financial literacy at an early age. But so I had a good foundation, but I didn't know much about investing. And so when I went away to school and got my first career, really, it was outside sales. And for anybody who's been in outside sales, like the actual executive sales role, I think you probably understand that you're on the road a lot. You have a lot of windshield time, and welcome to the world of podcasts, audiobooks, and anything in between. It's really around us always. And so for years, I just spent time on the road because I had this burning itch around real estate, just listening. So that's why Trevor, I was telling you is I love doing podcasts because this is how I learned personally. I spent tons of time on the sidelines, just understanding and really understanding what the power of a hard asset is, like a lot of people do. And as that went on, I saw a lot of things happen around me in the economy that kind of pushed me to finally take a step. So one of the things is, I said I grew up in Michigan. So 08, 09, I'm pretty sure most people understand that time frame, is there was a big recession, and particularly if you were in Michigan, around the automotive sector, or what we call the big three. And my father-in-law actually worked for GM for almost 40 years. And I remember him walking into the house, looking at us ghost face, and said, 2/3 of my retirement just went poof. It was gone. And I remember thinking, like, you worked your entire life to this moment. He was a year within retirement to have 2/3 of what he put away just magically go away. Not magically, there's reasons why, but essentially went away. There was no controlling it. And from that moment on, was determined over the next few years to find a way to control my own destiny when it came to retirement. We happened to pick real estate, right? So in 2020, we decided to finally, jump in the deep end and become an active investor. And we picked small multifamily. We picked the Midwest, mostly because honestly, we were comfortable with it. I'm a big fan of buying for cash flow and then looking at forced appreciation. Midwest is great, lower cost of entry, so your money went a little bit further. So we picked that. We bought a fourplex, and it was the scariest thing I've ever done, which is so funny thinking back 5 years ago now to that. I was terrified. 25% down, and we were, essentially making enough money to buy Chipotle once a month. Like that was about all we were getting. But hey, it was successful, right? It was like, proof of concept. And so when we bought that first one, my wife and I's conversation honestly was, well, let's just try to lower our retirement age. That was the only goal. So again, where you start and where you end is very different. So we started with just trying to lower our retirement age. That went well. We decided to buy a couple more. Our first year goal was 10 units. We ended up doing 50. Our second year goal was 25. We ended up buying 100, all small multifamily in Indiana. And through that, we finally decided, okay, well, that's going pretty well. And we would get a lot of single family houses. And we were talking about this earlier about what type of asset to invest in and things like that. But we decided to go ahead and try a flip because we get these opportunities and we were turning them down. Did our first flip, didn't lose money, went awful, as most people tell you, but we actually did pretty good on it, even though it didn't go super well, because I'll be honest, contractors are everything in that space. And that eventually grew to where we do about anywhere from 15 to 25 flips a year right now. Most we've ever done was 30. That was a really good year, but I think our sweet spot's that 15 to 25. So that takes us up to January 2022. And I'm going to kind of pause because I don't know if you have any questions or feedback on that, but it's a lot in a very short amount of time.
No, that's phenomenal. And it's funny that you mentioned proof of concept. I remember when I was doing passive investing and I was investing in mortgage notes, and it was through a fund, and they raised the minimum now, but back when I had done it, it was $500 to get into it. And I remember getting like that $3 or it was like $3 and change a month in distribution. And that was like, but honestly for me, it was like that was like the proof of concept. And then next thing, a couple months later, I got it and I ended up writing them a check for 25K because I liked it. But like you mentioned, it's just having that proof of concept, and it can be definitely scary in the first spot. But yeah, no, I'd love for you to continue. I have some questions about the multifamily space and the Midwest in particular, but feel free to continue.
Yeah, so that kind of takes us up to January 2022. A lot of lessons learned, right? When you're doing this actively. And what I didn't mention is my career up until this point, my technically full time career was in software sales and eventually a VP of a large software company in the automotive space. So, I'm doing this on the side. So I was essentially doing my W 2 job, the best of my ability, scaling the corporate ladder, but every ounce of effort I was going to put into this business and try to grow it. And so one of the things I always say to a lot of friends and family, whether active or passive, is, work for your money and then put your money work for you. And that was kind of our goal, was to continue to work for that money and then put it to work over and over again. So during this time, a good friend and neighbor of mine, Stan Remling, who was also doing something similar, just on a smaller scale. We're buddies, and we're, how it is with investing with buddies who are, they're not investing with you, but they're investing. And so we would talk a lot, and he had a couple small multifamily projects, and we both were like, man, we're working really hard buying these assets. They're doing okay. Like we're doing well. We're making money, but like, how do we grow faster? And this is no different than you've heard 100 times, and people who are listening have heard this 100 times. The way you do it faster is scale, generally speaking. Or one of the many ways. So we decided to go bigger, and Stan and I partnered on our business called Follow the Deal Investments. And again, what it started as and what it is now is different. So what it started as is Stan and I just partnering together, pooling funds, and ultimately buying these assets. What it became, because he works for Disney. We surrounded ourselves by, high net worth people, and just people who don't have the time, energy, and effort to invest actively. They would talk to us about real estate constantly. And what would happen, though, we'd have those deja vu conversations, right? Hey, Trevor, well, man, how's real estate business? You're like, oh man, it's great. I'm like, all right, tell me everything you do. Teach me everything. You teach me. And then next Friday, we'd have the same conversation, right? Yeah. Over and over and over again, like just constantly. And so my neighbor, Ryan, one night when Stan and I were all hanging out, having the typical guy BS session over some beers, he was like, man, how about I just give you $100,000 and you do it for me? And I literally was like, Trevor, I was like, Ryan, you're stupid. Like, why would you ever do that? Jokingly, he's one of our best friends. But in the next morning, he's like, no, for real, honestly. And I was like, you know what? Ryan's just like probably half the people we know. They've seen us doing this forever. They want to get involved. They do not want the work of it, but they want to diversify. And so that's the moment when Follow the Deal Investments actually became a small group investing company for our friends and family. Since then, we've added about 600 units, 650 units to our portfolio in the last 18 months. And about almost a year ago, we started our own property management company, because we'll probably get into that later, but so we can be vertically integrated and really control the property's destiny. So again, a lot in 5 minutes, but a lot of dips and turns and so on and so forth along the way. But that's where we're at today.
Yeah, that's a phenomenal story. And I really like where you mentioned to put your money to work for you. And that was the reason why I became a passive investor myself, because I was like, I'm too busy to be active. Nor I feel like I would be, I know we're talking about passive investing. I would be too passive with the tenants, and I would just feel like I wouldn't want to kick them out. I mean, unless I got a property management team, but I felt like I probably would have started small. So I was like, what's a way where I can start bigger? Okay. Oh, this company, they have a, 100-unit apartment complex in Dallas, Texas. Oh, I like what they have going on. I don't have to deal with any of the headaches. I'm just more checking on the sponsor, making sure they're doing a good job. Just I'm not gonna like blindly invest my money, but it's nice having that money just to give it to someone and let them put it to work instead of me trying to do all that back end legwork on my own. So I really like that aspect of it. But I'm curious, within like the multifamily space, I know some folks in the last probably like a year or so, they've had a hard time scaling or just finding deals. How's it been for you when it comes to finding multifamily opportunities? Are you doing basically, are you doing it differently than you had been a few years prior? Maybe getting more fixed rate debt, maybe a little percent lower LTV. Just curious how it's been in the multifamily space, from when you first got into sort of where it is now, where it's, I don't want to say it's taken a hit, it just gotten a little more tighter with just interest rates, just great going as high as they have. No one really could have expected that.
Yeah, I mean the rates. I mean, depending on when this gets released, I mean we were in the seven and well, anyway, it depends on how you structure your debt, but anywhere from low sevens to almost 8%. And when we first started, even in large multifamily, 18 months, 24 months ago, you were in the fives or high fours even at a point. So pretty drastic. So we our niche, again, in real estate, it seems like you have to kind of, in business you have to have a niche, right? Something that you're focused on. For us, we look at, generally speaking, 30 to 120 unit properties. We are kind of within 2 hours, 2.5 hours of Indianapolis, mostly because of an airport and logistics. And then that also allows us to have our own property management company because the properties are somewhat regional. But the other thing we really look at is, I don't get me wrong, I love Indianapolis, I love Fort Wayne, I love Cincinnati. You can name all these. I love Dallas, and we live near Orlando. Great markets, right? But those are tough markets. I mean, especially now they're really tough. And so, very early on, I mentioned about cash flow. So I think there's an affordable housing crisis. Personally, in the last few years, I think everyone would generally agree. And the one job that's incredibly safe is the blue collar job. And I will argue that till I'm blue in the face, because guess what? There's a lack of people that want to do it. And so you're not going to cut wages and fire people. What's going to get fired is the tech space, which we saw, right? A bunch of people working in tech got let go over the last couple of years, particularly out in California. So we really focus on that tertiary market where there's probably anywhere from 10 to 50,000 people, 60,000 people. There's good quality jobs, everything from, medical, education, industrial, so on and so forth. And because of that, with the interest rates, we're still able to somewhat find, and we've slowed down too, but we've still been able to somewhat find things that cash flow well, solid assets at a fair cost basis or cost per door. So I would say we haven't been hit quite as much as the average person, mostly because we play in that market. Now, if we're in Indianapolis or Dallas or Orlando, where the cap rates are so compressed, I think it would be a little bit of a different story. So I think just because of our niche and what we've leaned into, we haven't been quite as impacted, if that makes sense.
Yeah, that definitely makes sense. And I like that, looking at those secondary markets where it seems like a lot of these big cities have been the ones that have been crushed. I think adding up, I know you mentioned Dallas, but like Austin, I think I was talking to an investor that's been a terrible. It's crazy because it's like if you invested in Austin like in 2012 and then you just sold, you would have made so much money. But if you just got into it like a year or two ago, you would lose your shirt. It's crazy how that market has head up and down. And I feel like there's more stability in those secondary markets where, yeah, you want to have that appreciation, but maybe it doesn't appreciate as much as if you invested directly in Cincinnati. But because of that, you have a little bit lower risk. Maybe the cash flow is a little bit better. Like I know, like where I'm in, like if you're looking at the 1% rule, pretty much every multifamily you can get, you're going to get that 1%. I mean, I was looking at a deal. It was like a $250,000 4 unit, and you would get like it was like $1,250 a month per unit. So whatever that is, 5,000 a month. But in a year, the property might be worth 260. So it's not going to appreciate as much, but you get that nice cash flow coming in on the back end where the numbers make sense. But curious, in your deals that you're going out there and structuring, is there like, for the investors that are investing in the deals through your company, is there like a minimum sort of cash flow that you're looking like in year one and then spreading it out? Is there like an average IRR? Like let's say hypothetically, maybe 5% cash flow first year, or maybe by the end of it, we're trying to get to 8%, maybe the IRR, we're trying to find 12 to 15%. Just curious what someone could expect, like if they're investing with you, like what the sort of, obviously no return is guaranteed and every property is going to be different, but just curious, like what you guys sort of look for when you're looking at a property.
Well, I want to. I skipped one of your questions you asked earlier. I apologize about that. So you asked about leverage too. So we are still very much, as much 75, 80% leverage as much as we can. Construction lines. Again, we'll take the money. we're all about velocity of money. So, we're big fans of that. So let me just state that really quick in prior market conditions and now. But when we look at our deals, a lot of times we want to see that, kind of minimum 6% cash on cash return year one is what we're looking at. That doesn't really include rent bumps year one and some other stuff. And then as we go, really, you mentioned about appreciation. Well, we want forced appreciation, which for anybody who's listening who doesn't understand that, again, you're looking at gross income, essentially, or excuse me, net income, and then divided by your mortgage expense or your debt expense. Those are the things that you want to really look at. I said that totally wrong, by the way. I don't know why. I was thinking debt ratio there, but you get the point. So NOI, obviously, income minus expenses is NOI. So you want as you increase income and you lower your expenses, your NOI goes up, which means the value of the property goes up. That's simple. It's a pretty simple math equation. So where in Orlando, Dallas, and Austin, you're just going to get pure population growth, which will force the appreciation up. We're looking from forced appreciation through actual NOI. So I'll kind of make that point, but we're usually around that 6-7% return. And then we want to see that growth though, because when we're generally taking over property, it's usually a bad operator, maybe doesn't run quite as tight of a ship. Maybe they've owned the property for 30 or 40 years. They haven't pushed rents. And so we want to look at it from there. And then we want to try to get a refinance event somewhere in year 3 to 5, just depending on the property, return some capital, and then hold that asset as long as it makes sense.
Yeah, like that. I like it where you mentioned, like, if the asset makes sense, you guys just hold that as long, as possible, whether it makes sense to sell it year 3, year 5, 7, hopefully not. I mean, maybe if you wanted to, you could hold it however long, 20, 30 years, but if it makes sense to sell it and get that investor capital back. But I'm curious, I know we touched on it briefly, but how you built up that property management business, because I find that a lot of sponsors that I talk to, a lot of them just third-party management. And I don't know, just like obviously that works for some sponsors, but for me, I feel like when it's your own property management company, you're the one that's putting it all together. I don't know. It just feels like I'd rather invest with a company that owns the property management team or has that part of their business than a syndicator that's pushing it out to a third party. That, again, I'm assuming there's tons of good property management companies out there. That's just my preference as an investor, but curious how it's been for you and your company going out there and building up that property management team.
Yeah, I mean, that is a very valid point, and I do think it is a pro when you kind of pro and con different sponsors and different investing companies. I think it is a pro for a syndicator or a sponsor to have that. I think for us, we've used 5 different third parties in the past for property management. Some on the small scale when we first started, of course, which is a different type of asset. And we used 3 on larger assets. So apartment assets that are probably range from 50 to 90 doors at the time. And so what we really found was they have multiple owners, right? So, this case, it's me and you, right? You operate different than I do. So you hold their operations to a different standard. The SOPs are going to be different for you, what you expect. Communication cadence is different. And now we're going to have the same thing. We're going to have different cadences, different things we're looking for, different expectations. Now times that by 50 or 100 different owners who all have the same thing. It is incredibly inefficient to have 50 or 100 different standard operating procedures for a third-party property management company, but that's what they deal with. And guess what? They're not going to be good at it, right? So one of the main things and we couldn't do it till we had scale, right? It did not make sense to do it when we don't take on other third parties, by the way. It is 100% just for us. And the main reason is, back to the standard operating procedures, we want one. There's one way to do it. It's follow the deal / our property management company is called Thrive Property Group. So it's Thrive's way, and that's it. And so that alone creates so much more efficiencies across the board. And then it really allows our PM team to focus in on the day-to-day task and executing at a very, very high level versus going to meetings with owners, taking phone calls and texts. And it's very clean and very crisp. And because of that, we've seen, night and day improvements in every KPI you can look at.
Oh, I would imagine that, and I just feel like from a systems and processes standpoint, it just makes a lot of sense. I just think if I'm an operator, and I like how you mentioned that specific market that you're in, but I've seen operators, and maybe they have in Texas, and then Florida, Georgia, maybe they have something in Indiana, and all of a sudden they have all these different third-party property management. Maybe all let's say they have five different property management companies in five different states, five different systems and processes with those companies. I just feel like it would be logistically just be a nightmare. And where you have it in house, it just makes more sense. You can control everything. You control. It's just not like to micromanage them, but just to have that more aspect of control. Because I find that you could find a really good asset, but if you don't have that good property management team in place, it could it could underperform. Maybe there's a lot of tenant turnover. Obviously, more tenant turnover. I mean, depending on the unit, maybe there's more vacancy. Maybe the tenants leave and more people move in, depending on the market. So I really
Yeah.
like that aspect of it. But curious, like what's next for your company when it comes to, are you just guys continuing to look and find more deals when it comes to, say, the capital side of the business? Do you guys have like an ongoing opportunity where it comes to invest with your company, whether it's through a fund, or is it more like, hey, we have this new asset, we're going out and raising capital for it, to for past investors like myself? What does that sort of look like?
Yeah, so I mentioned earlier we are kind of friends and family, so it's a pretty close net investing group. But we are asset to asset today. So essentially, we're going to acquire an asset. We are going to market that asset to our group of friends and family. And generally, we do a lot of investor meetings up front with people to understand, like, Trevor, you have an 11-month-old baby. This is what your life looks like today. What type of asset? Because even within apartments, there's different types, right? There's going to
Yeah.
be kind of a shorter term gain, long term gain, what type of ROI, heavier lift, softer lift, all these different risk profiles. And we match that to people up front. And so our kind of goal is, before we even send it out through our CRM, and we use InvestNext for our investor portal, before we launch that, we hope to have anywhere from 35 to 50% of the slots filled up front. And it's because you kind of do that upfront work with the investor group. And then as far as like where we're going in the future, you mentioned the fund model. We have talked a lot about that because I think that could be an interesting play for us long term. What we invest in, we're staying very focused still on what we do today, which is, I would say, C plus to B plus Indiana assets, Midwest assets as a whole. And because our left hand of apartments feeds the right hand of the property management group, and it works really well together. But I could see us longer term, next 3 to 5 years, start to move into assets that are a little less labor intensive. As an example, we do invest in water parks and family fun centers. That's a story for a different day. And I could see us moving into some triple net stuff as well, just to diversify within diversification. So if you would have asked me 18 months ago or 2 years ago, Ross, where will you be? I would have never thought a year ago I would have, essentially stepped away from my W-2 job and went real estate full time. I would have never guessed that, we have a flipping company that, I would say is a business, is as its own thing, a substantial business, and then this group investing company. So it's always really hard to predict what you're going to go in the future, but I hope it's a lot of the same, and I hope we continue to grow in different offshoots that make sense.
Yeah, that's awesome. And I would say for the triple net lease, I know I'm invested in a triple net lease deal, and I like it. Just it's easy. It's for the
Mm-hmm.
most part, it's pretty safe. Like, to give you an example, so it's part of a fund model. So there's five different properties in it. One of them happens to be, it's either Dollar Tree, Dollar General, one of those dollar stores. But one of them, they foreclosed on 600 locations, and not I don't think one of ours is one of those locations. Where, I guess, to preface it for our audience, basically what a triple net lease is in a nutshell, where I'm going to go out and I own the building that's going to be rented out. In this scenario, it's going to be a corporate grade A tenant, and they cover a lot of the taxes, the maintenance, and the insurance. So for this example, the tenants are AutoZone, Dollar General, Family Dollar, like I was mentioning, where it's nice. Like, okay, yeah, one of these tenants, they're having 600 locations foreclosed on. If one of these locations happens to be ours, well, it sucks, but at the same time, we have a lease structured with them, and they have to pay on that lease for another 3 years, even if they foreclose on the location. So it gives us that 3 year timeline to go out and find a new tenant, hopefully. But it's also part of that fund model where if 4 out of 5 properties are underperforming, I mean, hopefully not 4 out of 5, 1 out of 5 is underperforming. Maybe it'll drag the returns down a little bit, but at least like you're getting some sort of cash flow left. So I definitely like the chip one at least. I mean, you're not going to hit it out of the ballpark with it in terms of returns. I think I get 7% on it. The goal is to get it to 10% by year 3 or 4. So I mean, it's a decent return, but it's not going to be like something you'd see in multifamily. But at least it's pretty stable cash flow. It's pretty. I like it from that perspective. But we were talking early on in our conversation, and I just wanted to bring up. I think it was more when we were offline, but curious when it comes to the financial freedom part of passive investing, and I think that was something I had to learn on my end from being on LinkedIn, and I see a ton of people just promoting passive investing and retire early, and I know for me, like I have 100K invested, and I get like $800 a month off those investments, and I'm like, that's nice, but I mean, that's not going to be retire. I'm not going to be able to retire on that. I mean, I'm always saving up to get into that next deal. And I like where you mentioned it could lower your retirement age, where maybe you're planning on retiring at 60, and then now you can retire at 55 or 50, and you can buy back some of those years of your life. So just curious when it comes to your perspective, what it looks like, when it comes to passive investing and trying to build up that financial freedom. Because I think it can be a little bit misleading sometimes to especially newer passive investors, what they might see online.
Yeah, well, in general, we're in this instant gratification age in 2024 in the last few years with obviously social and things like that. But I mean, there is so much propaganda out there about get rich quick, invest passively, retire at age 25, all that is BS. 100% propaganda. And I don't care who you are, because at the end of the day, a passive return is going to hopefully be between, somewhere 6 to 20% on the high side, the 6 on the low side. 6% is lately essentially paces inflation. So there is no way. And by the way, generally S&P 500 and stock market's going to be between 5 and 7. So let's just call that 6 too. So 6 is a way to diversify essentially what you would be doing in other retirement funds. Above that is going to then lower your retirement age, not have you quit your job. So, if you double that, you can do the math. If you're getting a 12 or an 18% or triple that, 18% return, that is going to lower it by X amount of years. And that's the type of thing you need to look at isn't how I'm going to retire by investing passively. It's how am I, you said it best, how am I going to get some more of that time back? And I think that's really, really crucial. And then, for those who want to be active, don't get me wrong, being active is awesome. It is, but it is a lot of work. And it is not for 99% of the people out there, because it is stressful and there's a lot of work. But do you get a better return when you're active? Potentially. Yeah, you potentially do, because you're doing all the work, and you should, by the way. So that's kind of one thing. I did want to jump back to something, and I wrote it down really quickly, so I'm sorry to squirrel a little bit on. You mentioned IRR and metrics earlier. So we were kind of talking about like propaganda. IRR is a bullshit term too. Sorry. Mm-hmm. So it has a place and it's a metric, but it's a metric that can be completely manipulated. Example, we had a project, and I do this every time because generally a friend or a family member will mention IRR to me. So we have it in our deck: cash on cash, equity multiple, IRR. Those are the 3 metrics at the bottom, because somebody's going to ask you about it, right? So they'll ask you about it. And we had an IRR. It was like, 22% or something like that. Great IRR, right? That's a really good IRR. But what I was trying to explain to them, if I took the sale event from year 5 and moved it to year 4, the IRR goes to like 28% or 27%. Now, if I move that sale event back 1 year, so from 5 years to 6 years, it goes to like 17%. So just by moving certain events 1 year, 2 years, either way, is going to dramatically impact what the IRR is. So I always joke, tell me what IRR you want, and I'll make this say that. Because that's how you can, the number that as an LP investor or a passive investor or an active investor, IRR matters because it truly is a metric of your money and how hard it's working for you. But once you buy an asset, you have no idea what's going to happen the next year. You have zero idea, or 3 years or 5 years or 10 years. We have 3 assets we're selling right now. All 3 were long-term holds, and we're selling them in 18 months.
Oh wow.
Every one of them, because one ended up being a bigger project than we expect. We're going to get our capital back and make some money real quick on it. The other two are smaller assets, and we decided let's go ahead and sell those and move that money into larger ones. And so, just when you're interviewing sponsors and GPs, or just looking at financials as a whole, take IRR with a grain of salt. Lean into cash on cash. Lean into equity multiple.
Yeah, I think that's like you mentioned, it can definitely be manipulated. And I think when, at least for me, when I was looking at sponsors to invest in, it's almost like I got to go through and learn how to do the underwriting myself just to make sure, confirm like one, like what's the rent growth, like are they underestimating the vacancy depending on the class of property, capex expenses, different things like that, where you can definitely go through and you can manipulate the numbers to make it look like you're getting a better return. Where it's like, okay, you want to bump rents from, let's say, 1,200 a month to 1,500 a month, but if
Yeah.
every apartment complex similar in the area with what your upgrades are going to be is 1,300 a month, can we really get that 1,500 a month? Maybe, but is that over projecting? And then maybe if we bring it down to 1,300 a month, we just bump it up 100. Now the, like you mentioned, like the IRR maybe, or the return goes from 15% to 10%. Well, I'd rather you tell me 10% and then we get the 15% instead of me getting excited about what I'm going to be getting as a return. And then something else like I want to talk about that you mentioned, I found that was helpful for me, was when I was thinking about like the retirement age. Whereas I basically looked at it as like, okay, if I invest in real estate, let's just hypothetically say I got a 2x equity multiple over 5 years, just make it pretty standard. I know hypothetically, if I invest in the stock market, I'm gonna double my money in 7 years. So for me, when I was looking at real estate, I can double my money in 5 years versus 7 years, and then you go out another time period. Now I can double it in 10 years versus 14 years. And then when you start to do that, you start to realize like, oh, by investing in real estate, by just getting a little bit better of a return, I can shave 7 to 10 years off the retirement age. And that's not including like if you double your money even sooner or different things like that that may occasionally happen if you get a little bit better out of a return, or you invest in like a private equity fund, or different things where you can get maybe a little bit more risky. So I do like that you mentioned that. I think I wish more people were talking about that, where it's you
Yeah.
can buy back your time, but it's not like some, unless you have like 1 million, 2, 3 million to start and you can put into it, which most people that have that are going to be near the retirement age to begin with, unless it's someone I know maybe younger that had it really good. Maybe they sold their company in their 30s, but for most folks, that takes a decent amount of time to acquire that amount of wealth. But I really enjoyed that. But I wanted to dive in real quick before we have to hop off. But curious what it's like been building that fix and flip business. I know you mentioned you do anywhere from 15 to 20 flips a year. I mean, for me, I'm like, maybe I'll do one, and that seems overwhelming. So for you to do 15 to 25 a year, just curious how that's been. I'm assuming you have some sort of systems and processes in place to make it run smoothly.
Yeah, I mean it's a evolution of system and processes. So I mean that's all flipping really is it's a math equation up front. I'm buying a hard asset. I have to spend a certain amount to get that asset retail ready to sell, and then so those are two numbers you have to figure out. And then what can I sell it for, and what's my cost to sell? And does that leave me enough profit conservatively that it makes it worth its while? Now, there's a million variables in between that get complicated, but again, it's people, process, and technology, like anything in business. So, we had started with one construction crew. We used then a second one for about 3 years, and now we're on our third one that we, because again, relationships of things. These are a lot of times hard to find good people that you can trust, and eventually it seems like always trust seems to be broken somewhere, and you have to find the next person. But we've done about 50 to date. And what we do is we when we find an off market, on market, doesn't matter. We have the realtor and our construction team go out and visit that property. Most of these properties I've never been in, never
Hmm.
seen them, never touched them, never been in them. So all these are up in Indiana, just like the rest of our business. So they go in and they write a bid up to get that retail ready, and then I do the math on the backside to determine whether that it really makes sense. Realtor helps me with some comps just to make sure. Pretty much we know now what everything's going to sell for roughly, but some comps, and then we will negotiate that price based on what it needs and what we could sell it for. And then everything from there on is all the construction side. And then it's the listing and trying to sell the property. But when you really boil down flipping, as long as you understand the potholes or the pitfalls of it, it is no different than any other business. But what people do is they get attached to these and they treat it like a hobby. And they go and they try to tear out stuff themselves. They go and they try to over rehab it because they want to make it super cute. All these different things. It's a business. So
Yeah.
it is buy for this and invest this much more money to get it ready, sell it for that equals profit. That is it. That's all that matters to me. I don't care what the asset is. I don't care, I do care about how long it's going to take and how heavy of a lift it is. But essentially, like, I don't care. If the numbers work, they work. And so you got to do it as a business, just like real estate, as far as apartments go, and just like you and your business. You treat it
Mhm.
like a business, it's going to pay you like a business, as they say. You treat it like a hobby, it's going to pay you like a hobby. So we've been very fortunate early and often to always treat it like a business. And I think that's really why we've had a lot of success in a lot of different categories.
Yeah, that's phenomenal. And like you mentioned, I love it that you're just still doing the long distance, from Orlando to Indiana, and it just proves where you don't have to do it in your local market. So I really like that as well. But Russ, I want to be respectful of your time today. And the last question I want to ask you is, if our audience wants to learn more about you or has any questions, where can they get in contact with you?
Yeah, so we were joking about this. I'm not a big diehard social media guy, but I do put a lot of effort into LinkedIn. I think LinkedIn and these podcasts are a lot of how I learn. So you can find me personally on LinkedIn. Again, ROSS Ross McArthur McArthur. And if you want to learn a little bit about what we're doing, kind of the type of assets we're buying, and just kind of see what our business structure looks like, our website followthedeal.com.
Awesome. I'll make sure to include that in today's show notes. And Ross, again, thanks so much for coming on to the show today.
Awesome. Finally, nice to meet you face to face too.
Likewise, thank you.